It's Wednesday, 18th of February, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day.
Let's get straight into it. We are starting with the pulse of the Indian economy, and frankly, the pulse is racing a bit faster than the central bank might like.
Oh, really? What are we seeing?
Well, wholesale inflation, the WPI, it's ticked up to 1.81% for January.
See, 1.81% sounds incredibly low, compared to the historical averages we're used to. Is that really enough to set off alarm bells?
In isolation, probably not, but you have to look at the cocktail of data it's served with.
Okay.
That inflation number is pairing up with a widening trade deficit. The gap between what we sell and what we buy has grown.
And why is that?
It's primarily because January saw a massive surge in imports. So when you have rising wholesale prices and a ballooning import bill, it suggests the cost of doing business is climbing.
And that pressure eventually has to go somewhere.
It has to.
And I think I know exactly where it's going, right to the supermarket shelf. I was looking at the FMCG sector, and it looks like the days of discounts are officially over.
They certainly are. We're seeing price hikes of up to 5% across the board.
But why now? It feels like just yesterday companies were talking about volume growth, keeping prices steady. What changed?
Two things really just collided. First, remember the GST cuts back in September? After that, there was an informal moratorium, a kind of hold fire period where companies absorbed costs. Well, that moratorium has expired.
I see. And the second thing?
The bigger issue is raw material. Commodity costs are surging, and the rupee has weakened slightly against the dollar.
So it's a double whammy. It costs more to import the ingredients because the rupee is weaker and the ingredients themselves are just more expensive.
Exactly. When your input costs rise and your currency buys less, margins get squeezed. That 5% hike isn't just greed, it's a release valve.
Right. If they don't raise prices, their balance sheets start to bleed.
Just like
Speaking of balance sheets, not everyone is bleeding. In fact, if you look at the energy sector, specifically the state-owned oil marketing companies, IOC, BPCL, HPCL,
they seem to be having a party.
a party is an understatement.
Yeah.
Their combined profits have more than doubled in the December quarter. It's a massive turnaround.
It is.
Okay, help me reconcile this. You just said imports are expensive and the rupee is weak. That's usually a nightmare for oil companies.
Yeah.
How are they doubling profits?
It comes down to two technical factors: refining margins and the mystery of under-recoveries.
Okay.
First, their refining margins. The spread between the cost of crude and the price of petrol they sell remained very robust.
So buying smart, selling high.
You got it. But the real kicker is the LPG under-recoveries.
Right, under recoveries. That's one of those corporate terms that sounds like a euphemism for we lost money. Can we unpack that for our listeners?
Yeah, it's essentially a subsidy burden. In simple terms, an under-recovery happens when the government tells these companies, you must sell this cooking gas cylinder at 800 rupees, even though it cost them 1,000 rupees to produce.
So they under-recover the cost.
Exactly. Usually the government pays them back later, but it sits as a drag on the books. This quarter, those under-recoveries dropped significantly.
So they just aren't being forced to sell at a loss as much as before. That makes sense.
It's less of a windfall and more of a normalization of their business.
All right, let's pivot from the macro to the stock market. Because while oil giants are celebrating, some retail favorites are looking pretty sick. Asian Paints is the big one.
Yeah, the stock has shed roughly 10% since late January.
And Asian Paints is often called the GDP of the housing market, right?
It is. When people buy houses or renovate, they buy paint. The fact that it's down 10% is the market pricing in a slowdown. Their quarterly performance was, well, lackluster.
Which signals that consumer demand for home improvement is softening.
It is.
It's the lipstick effect in reverse. People aren't repainting the living room. And speaking of discretionary spending, look at Ola Electric.
Shares hit a record low.
What's the story there?
That's a different beast. That isn't just demand, that's an execution problem. The Q3 results were weak. And in the EV sector, cash is oxygen. You need huge capital.
And when you miss your quarterly targets,
brokers downgrade you immediately. The path to profitability suddenly looks a lot longer and rockier.
it just seems like the market has zero patience right now. Look at Fractal Analytics. This was supposed to be the darling of the season, a pure AI play.
And it closed its debut day down 6%.
What does that tell you?
This is fascinating because it marks a shift in sentiment. I think we're seeing AI fatigue.
Already? I thought we were just getting started.
Technologically, we are. But financially, the hype cycle might have peaked. A year ago, any company with analytics in its name would have popped on listing day.
Oh.
Now, investors are skeptical. They're looking at Fractal's valuation and saying, okay, but where's the cash flow? They aren't paying a premium for the promise of AI anymore. They want the performance.
That is a perfect contradiction to lead us into our second segment, the AI shift. Because on one hand, you have investors punishing Fractal.
And on the other, you have infrastructure giants pouring billions into hardware for tomorrow.
It's the difference between selling the software and owning the roads.
Exactly. Look at Yada Data Services. They are making a multi-billion-dollar bet, not on software, but on chips. They're deploying NVIDIA's latest hardware in Noida.
And they aren't alone. The Adani Group has thrown down a massive pledge to build India's sovereign AI infrastructure.
And that word sovereign is the key. This isn't just about building data centers to host Netflix. This is about national capability.
Explain that concept of AI sovereignty. Why does it matter if the servers are in Noida or Nevada?
It matters for two big reasons: latency and law.
Speed and rules?
Right. You want compute power close to users for speed. But more importantly, data privacy laws are tightening. India wants its citizens' data processed within Indian borders, subject to Indian laws.
So if you rely on foreign compute, you're vulnerable.
You are. Adani and Yoda are betting that Indian enterprises will pay a premium to keep their brain power domestic.
So it's a play on regulation as much as technology.
Yeah.
Adani wants to be the landlord of India's digital brain.
Exactly. And look at their strategy. It's vertical integration. They're not just building the server racks, they're powering them with their own green energy. They want the entire stack.
And meanwhile, the software giants are having to pivot to stay relevant. Infosys is teaming up with Anthropic.
This is a survival move. The old model of body shopping, hiring thousands of engineers, is dying. Infosys knows it.
So they're partnering with Anthropic to build custom AI agents. Agents is the new buzzword, but how is that different from a chatbot?
A chatbot talks to you, an agent does things for you.
Okay, give me an example.
A chatbot answers a question about your travel policy. An agent books the flight, expenses the receipt, and updates your calendar.
I see. It's about autonomous action.
Yes. And the CEO has set a target for massive AI revenue by 2030, because if they don't hit that, their traditional revenue will just erode.
And sitting at the very top of this food chain, eating everyone's lunch, is NVIDIA. Their managing director described their strategy as a 5-layer cake.
It's a great metaphor. Layer 1 is energy. Layer 2 is the chips. Layer 3 is infrastructure, the data centers.
Layer 4 is the models, like what Infosys is using.
And layer 5 is the application, what you and I see. NVIDIA is betting on India because India is one of the few countries with the scale to consume the entire cake.
Meaning we have the energy needs, the data center ambition, the engineering talent, and the population for the apps.
Precisely. Most countries can only do 1 or 2 layers. India is a full-stack market.
All right, let's zoom out. All this infrastructure needs stability, and right now the global picture is anything but. Let's talk commodities, starting with oil.
All eyes are on Geneva. The U.S. and Iran are talking.
And talking is better than shooting.
That is exactly how the market sees it. There's a glimmer of de-escalation. A deal isn't imminent, but the simple fact they're at a table has sucked some of the risk premium out of the oil price.
So oil prices have dipped slightly because the fear has faded.
Correct. Traders are unwinding their war bets.
But if oil is calming down, precious metals are having a panic attack. Gold is down about 1.23%. With silver, over the last fortnight, it has tumbled nearly 38%.
38% is a crash, plain and simple.
Why is silver getting hammered so much harder than gold? Aren't they both safe havens?
No, and this is a common misconception. Think of silver as having a split personality.
Split personality.
Yeah, it's half precious metal like gold and half industrial metal like copper. It's used in solar panels, electronics.
So when the economy looks shaky, the industrial side drags it down.
Exactly. Gold is purely a fear trade. Silver is a growth trade and a fear trade. Right now, geopolitical fear is fading, hurting the precious side, but the industrial outlook is weak, which crushes the industrial side.
So it's getting hit from both directions.
It's like gold on caffeine. The highs are higher, but the crash is much, much steeper.
That explains the disparity. Now, moving to global investment flows, we're seeing a fascinating shift with Japan. They're making massive investments in U.S. infrastructure.
This is a strategic alignment. We're seeing Japanese capital flowing into things like gas power plants and, interestingly, synthetic diamonds.
Synthetic diamonds. I thought those were for jewelry.
Not these, it's not for engagement rings. Synthetic diamond is a critical material for high-end semiconductors. It's the ultimate heat sink. It cools down advanced chips better than anything.
So this is about securing the supply chain for next-gen electronics.
That's right. They're embedding their technology base directly into the U.S. industrial complex. It's another layer of the chip war, disguised as a gemstone investment.
Smart. Finally, let's look at the UK. The economic data there is looking grim. Unemployment has touched a 5-year high.
The British labor market is cracking.
And yet, looking at the bond markets, traders seem almost happy about it.
Welcome to the perverse logic of macroeconomics. Bad news for the worker is often good news for the trader.
How so?
High unemployment means the economy is cooling. If the economy cools, inflation drops. If inflation drops, the Bank of England has to cut interest rates.
And traders love rate cuts.
They love cheap money, so they see a jobless report and think, great, the rate cut is coming. It's harsh, but that is the mechanism.
It is the cold calculus of the market. Speaking of cold calculus versus biological reality, let's shift gears for our innovation closer. We are looking at biology.
We are. Researchers have successfully built a lab-grown human spinal cord.
That sounds huge.
It's a profound breakthrough. And let's be clear, we aren't talking about a few stem cells in a petri dish. They have built a realistic, functioning, mini spinal cord model.
Wait, so this is something you can actually see? It's a visible structure.
Yes, it's a tangible biological structure, and they actually simulated a traumatic injury on this lab-grown tissue to see how it reacts and heals.
That's incredible. But why is it such a game changer? Don't we test this stuff on rats or mice?
We do, and that's the problem. A mouse spinal cord is not a human spinal cord. The biology of healing, the way nerves scar, it's different.
So this allows them to test directly on human tissue.
Exactly. To reproduce the specific damage seen in human spinal cord injuries and test treatments on human biology from day one.
And without the ethical nightmare of animal testing or the risk of testing on patients.
It just accelerates the timeline for a cure. It's like building a biological scale model of a skyscraper to test earthquake damage rather than just testing the steel beams.
That is the kind of science that eventually translates into miracles. A great reminder that while we obsess over stock prices, the real progress is happening in the labs.
Absolutely. Markets fluctuate, but human capability keeps compounding.
And just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only, and should not be treated as investment or trading advice. We are not licensed financial advisors. Please do your own analysis or take independent professional financial advice before making any investments based on your own personal circumstances. Past performance is not indicative of future returns.